Welcome to the video. First, we will set the stage for why student financial independence matters and how to build credit the low-risk way. Next, we will outline the agenda, then share a short disclaimer to keep everything responsible. After that, we will dive into the bank strategy and credit building steps, and we will finish with quizzes, key takeaways, and a summary. Let's get started. Here's today's agenda. First, we'll discuss why financial independence matters for students. Next, we'll cover an optimal banking setup using a checking account paired with a high-yield savings account. Then, we'll walk through a practical student budget that prioritizes stability. After that, we'll dive into how to build credit safely with small, predictable charges and on-time full payments. We'll also give you a step-by-step execution checklist. And finally, test your knowledge with a couple of quick quizzes before we wrap up with key points and a summary. Before we proceed, here is an important disclaimer. This video is for educational purposes only and is not financial advice. Interest rates, fees, and availability of products differ by institution and location. You should verify FDIC or NCUA insurance, read all terms and conditions, and consider consulting a qualified professional before making financial decisions. With that established, let's move smoothly into why your independence first setup matters. Let's set context. As a working student, your primary financial goal is not maximizing flashy rewards. Instead, it is preserving every dollar you earn and growing an emergency fund with minimal risk. This mindset prevents costly mistakes, builds confidence, and sets the foundation for responsible credit building. Now that we've framed the objective, let's transition into the exact banking setup that supports it. Here is the core banking strategy. First, open both a low or no-fee checking account and a high-yield savings account, ideally at the same online bank for smooth transfers. Next, prioritize institutions with competitive APYs such as Capital One, or discover and verify their current rates and fees. Then, link the accounts and set an automatic transfer of 10 to 20% of each paycheck into your HYSA to build an emergency fund without thinking about it. After that, use your debit card for daily expenses to avoid credit card overspending. Keep the HYSA dedicated strictly to emergencies and short-term goals, not discretionary purchases. This separation between daily cash flow and protected savings creates structure and lowers risk. Now let's go step by step to open and optimize these accounts. Let's translate the plan into concrete steps. First, choose an online bank that has no monthly fees and offers a strong high-yield savings rate. Second, open the checking account and then the HYSA with the same institution for seamless linking. Third, enable your debit card and add it to your mobile wallet for easy access. Fourth, set up automatic transfers, starting at 10% of each paycheck and increasing to 20% if your cash flow allows. Fifth, label the HYSA with a clear objective, such as emergency fund for 3 to 6 months of essential expenses, to reinforce its purpose. Sixth, enable account alerts for low balances, large transactions, and payday deposits to improve awareness and security. Finally, review your account terms and fees every quarter, and do not hesitate to switch if better options appear. With the bank setup complete, we can now compare traditional savings to high-yield savings to reinforce why this matters. Here is a quick contrast. Traditional savings accounts typically pay very low interest and may include monthly fees and slower transfers, which means your money often loses purchasing power against inflation. In contrast, high-yield savings accounts usually offer competitive rates, often have no monthly fees, and enable faster internal transfers when paired with checking at the same bank. This combination enhances both preservation and accessible growth. Now that the banking base is clear, let's shape a student-friendly budget that feeds your HYSA automatically. Let's visualize a simple student budget. A practical target is allocating around 20% of income to the HYSA while covering essentials. To achieve this, focus on reducing fixed costs first by leveraging roommates, campus resources, and available student discounts. Align your automatic transfer date with your payday, so the savings happen before you feel the temptation to spend. Psychologically, treat the HYSA contribution as a mandatory bill. With budget structure in place, we can move to the credit building strategy that protects your score and your cash. Here is the credit building approach. First, apply for a student-oriented card from a reputable issuer that accepts thinner credit files. Second, restrict usage to small, predictable expenses, such as a streaming subscription, gas, or a modest campus dining purchase. Third, keep your utilization under 10% of your limit at all times. Fourth, enable autopay to pay the full statement balance every month. Fifth, disregard flashy perks and focus on repetition and discipline, which build credit fastest while limiting risk. Sixth, do not carry a balance, because interest charges quietly erode your cash. With the rules set, let's turn them into a weekly routine you can actually follow. To make this sustainable, create a weekly routine. First, select 1 or 2 predictable charges totaling $10 to $50 to place on your card. Second, enable full statement autopay and alerts so you never miss a payment. Third, review utilization weekly and keep it under 10% of your limit. Fourth, if you accidentally make a larger purchase, pay it off early to bring utilization down before the statement cuts. Fifth, every 6 months, request a credit limit increase if your income and payment history support it. Finally, avoid unnecessary new applications to protect your average age of accounts and your score. Next, let's illustrate your first year with a timeline. This timeline shows a realistic first year. In month 0, apply for a student card, enable autopay, and set alerts. From months 1 through 3, put $20 to $50 of predictable spending on the card and pay in full. Around month 4, you may see score updates if reporting cycles align, provided your utilization remains under 10%. At month 6, request a credit line increase if your payment history is perfect and your income supports it. From month 7 to 11, protect your on-time streak and avoid unnecessary new applications. At month 12, you can consider adding a second no-fee card to increase your available credit and strengthen your profile. Now, let's briefly show how a single purchase flows through the system. This sequence diagram explains the life cycle of a card transaction. First, the student makes a purchase at a merchant. The merchant routes an authorization request through the card network to the issuing bank. The issuer approves or declines the transaction and places a hold. Later, settlement occurs, and the transaction posts. A statement is generated at the end of the cycle. If autopay is enabled, the full balance is paid on the due date. The issuer then reports payment status and utilization to the credit bureau. On-time payments and low utilization support a stronger credit profile. With mechanics clear, let's examine a few common starter card options at a high level. Here's a quick, non-exhaustive snapshot of common starter card categories. Capital One and Discover offer student-oriented products that can work for thin files, typically reporting to all major bureaus, which is important for building credit history. Chase Freedom Rise is an example of an entry product that may be available depending on relationship or deposit. If you are not approved for an unsecured card, consider a secured card that requires a refundable deposit and can graduate to an unsecured version with a solid on-time payment history. Always verify fees, APR ranges, and terms directly with the issuer. Now, let's test your understanding with a short quiz. Quiz time. Question: if your current savings are minimal, what should your primary financial focus be? Option A, preservation and low-risk growth. Option B, chasing high rewards and cashback. Option C, day trading to accelerate returns. Option D, speculating on volatile assets like crypto. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is preservation and low-risk growth. When savings are minimal, your first priority is to secure your cash and build a cushion, not to chase aggressive returns. A high-yield savings account paired with a disciplined budget supports this approach. Now let's continue with one more question. Here is the next question. What is the simplest way to build credit quickly while minimizing risk as a student? Option A, put all expenses on the card and carry a balance. Option B, use the card for small, predictable charges and pay in full monthly. Option C, open multiple cards at once to increase limits. Option D, ignore utilization and focus only on rewards. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is to use the card for small, predictable charges and pay in full every month. This approach keeps utilization low, prevents interest charges, and steadily improves your payment history, key components of a strong credit score. Moving forward, let's highlight the key principles you should remember. Here are the key principles. Open both a checking account and a high-yield savings account, and automate transfers. Preserve your cash first by targeting 3 to 6 months of essential expenses in your emergency fund. Use your credit card for small, predictable expenses only. Pay in full and on time every month by enabling autopay. Keep utilization under 10%. Finally, review your accounts quarterly and switch if better options appear. Next, let's summarize everything into a concise checklist. Here's the recap. First, open a checking account and a high-yield savings account at a competitive online bank, link them, and automate transfers. Second, structure your budget so that 10 to 20% of income is saved before you spend. Third, apply for a student-friendly card and use it only for small, predictable items. Fourth, pay statements in full and keep utilization under 10%. Finally, reassess fees, interest rates, and card terms every quarter to maintain an optimal setup. As we close, I have one request to help this message reach more students. Thanks for watching. If this video helped, please like it, share it with a friend who needs a clean money system, and subscribe for more practical guides. Tell us in the comments what your next money move is, whether it's opening a HYSA, automating transfers, or setting up your first student card. See you in the next video.